Hey folks, how you doing? It's Friday, May the 9th, 2025, and let's talk about what's happening in crypto and Bitcoin. I'm sure you probably noticed, maybe you have, maybe you haven't, I don't know, but that the Bitcoin price yesterday during the Alpha Trading live stream hit the 100K mark again, and breached through it, and that was around, what time was it? Like, I don't know, around 9:15 or something like that, Eastern time, U.S. Eastern time. Something like that. 11:15. Yeah, I think 11:15 U.S. Eastern time. Yeah. Anyway, somewhere around there, 11:15, 11:20, 21, whatever it was. And of course, the whole crypto market is a buzz with it's back over 6K and six figures. It's back over. It's back in six figure. Now we're going to the moon. Yeah. Okay. All good and well. Keep in mind, while it certainly technically has some room to run, and the honey badger can do very improbable things, it is also important to remember that there are mean reversions right now in progress to RMLRs on different time frames that are currently below the asset. Okay. Now, what does that mean? Well, to be very specific, it means exactly what I just said. It means that there are um, different time frames on which the asset has run into the third standard deviation band to the upside of those RMLRs. Again, if you don't know what the RMLRs are, they're reverse mean of log returns, right? So if you haven't learned about how to use those, you probably should, because those are very powerful tools that can tell you, um, the RMLR and the outer bands. They can tell you when the asset is in distribution and when the asset is in mean reversion. Right now, even though the asset's continuing to run up, it is technically in mean reversions to the RMLR, which is below it. On different time frames, there's different mean reversions happening, right? What does that mean for you? Well, it means that although it's running up, it certainly could mean revert. It could mean revert, by the way, by going to the upside, just at a lesser slope than the RMLR will rise. So the RMLR could rise fairly sharply, and then the asset can continue to rise and run into it. Or it can go kind of sideways, and the RMLR can rise up to it, and the asset can run into it. Or the RMLR can continue to rise as it's doing, or even go sideways, or it might even drop a little. We'll see. I guess it's a dynamic line. But at the moment, it's rising, and the asset could indeed come down towards it and meet it below. Now, why does that matter? How is that useful? Well, it can go up, down, or sideways. That's true. It can go up, down, or sideways. Right? It can always do those things. How is that useful? Well, because you know that the RMLR is a target. It's a moving target, but it's a target. You know that the direction of it is very accurate, right? It's showing you that the direction of it is very accurate. It's showing you that the future line direction of it is very accurate. Meaning, if it says the next candle, the RMLR is going to go up, it is probably going to go up, right? The overwhelming majority of the time. Sometimes it'll be, it'll go the other way. It'll change. It'll paint to the other side, or paint sideways or down when it said originally it would go up. That does happen. Why does that happen? That happens because we're talking about a dynamic market. But does it happen often? No, it doesn't happen that often. You know why? Because of the maths, because of the power of the RMLR, right? We know what it is in fact capable of. We know that the RMLR is able to predict with extremely high accuracy the future direction of the RMLR. Now, is it 100% accuracy? No, nothing's 100% accuracy, but it's bloody close, right? Like 99.7% of the time or whatever. It's ridiculously close. Okay? It's literally like a third standard deviation band. of accuracy. It's a big fat outlier on a regular basis. Again, because of the maths, not because of some magic crystal ball nonsense, right? It's just math, right? So, um, so what does that mean? Well, it means you can use the RMLR as a target, and you can use the outer bands as a target, right? Either of them are take profit zones, or God forbid, limit loss areas when you're on, like, let's say super low time frames and they're very, very tight. Um, but there shouldn't be limit loss areas ever. They should really be just take profit zones. And the reason for that is because your limit losses should be much less usually than, like, you shouldn't be targeting to those things for limiting your loss. You should be targeting by percentage based on the information overall, right? And you shouldn't ever want to lose more than, maximum like 1%, right? If you're losing more than 1% on a trade, that's bad. It's bad, right? Now, I understand if you took leverage, it's very easy for that to go to 2%, 3%, 4%, 5% very quickly. Well, that's why using leverage is bad. Because if you lost 1% on a trade without leverage, that's 1%. And as terrible as it is, it's 1%. If you use leverage and now suddenly you lost on the same trade, you lost 5%, 10%, 15%, 20%, that's really bad, right? It means you have to have a lot more money to burn to do that kind of foolish behavior. Now, do you have money to burn? Because if you don't, you really should not be using leverage, right? It's just that simple, right? Because of the inherent risk of using leverage, right? People say, well, you can't stack enough in a day if you don't use leverage. You can't beat the market if you don't use leverage. Really? You think you can't beat the market if you don't use leverage? Okay, nice one. How about, first of all, if you want to look at it that way, A, you're never going to beat the market because you cannot trade 24 hours a day, 7 days a week. Like, you can't be, I mean, unless you're some kind of artificial synthetic Borg that sits in front of a machine 24/7. Like, basically, if you are a bot that runs an HFT firm's trading, then yeah, maybe you can trade all day. But if you're a human being who has to, like, I don't know, ever go to the bathroom or eat or sleep or do anything away from your computer ever, then you also can't beat the market on every move. It's not possible. There are gazillions of moves, literally billions of trades happening every day. How can you beat the market? You can't, right? Oh, but I beat the daily average. Oh, really? You beat the daily? What about the hourly average? What about the 1 minute average? It's ridiculous. Okay, these are false vanity metrics for people to feel good about themselves. All that matters, and when I say feel good about themselves, I mean they feel good that other people lost as much or more than they did. Because most people in trading lose money. That's just a fact. Okay? You want to make money in trading, the simplest way to do it, for most people, not people who trade with leading information. If you trade with leading information, you can make serious money. And if you know what you're doing, a lot. But if you don't know what you're doing, the easiest way to make money in trading is don't trade. Second easiest way to make money, be an investor. You can call yourself a trader, and then you just DCA. That's how you make money in trading. Look, purple haze all in my brain. Lately, things just don't feel the same. Acting funny, and I don't know why. Excuse me while I kiss the sky. Yeah, Jimi Hendrix. Anyway, yeah. So that's the simplest thing to do. It's the easiest way to do it. I'm going to continue in a minute here. Just got to step down here. Be right back. So, again, what is the market likely to do? Well, as I explained to you, there's still room to run to the upside on Bitcoin and on a bunch of assets, even though it's technically a mean reversion. Likewise, it can go sideways and mean revert, right? Like it can run out of steam around here, kind of go sideways for a while, hit that mean reversion, and then set forth on a new distribution target, right? Or it could also mean revert to the downside, which is why you have to be careful, especially when you're trading low time frames, and even more so if you're using any kind of leverage whatsoever, obviously, right? I mean, just for example, yesterday, while it was running up, right, as soon as it busted past 100, it went up to like 101, I think almost 102, but it went up to like 101 and change, and then immediately had a little pullback on Bitcoin. I'm talking about like a 0.5% pullback, 0.56% or something. And in that little tiny pullback of 0.56%, I think it was like more than $10 million or even $100 million worth of liquidations in a 15-minute period on longs on a 0.5% pullback. Right? Think about what that means. That means if you're getting liquidated on a 0.5% pullback, it means you're using something like 200x, right? Or at least like 180x or whatever, because the liquidation fees and the trading fees and all that stuff, it comes out to, you're using almost 200x. It's crazy, maybe less, but like 150 or 170. It's insane. If you're using that kind of leverage and you don't think an asset that's that volatile, that just pulled up however many percent, like 6% in the day, if you don't think an asset that pulled up like 3% or 6% in a day can pull back a 0.5% just for a little reset, which is all it was. It was a little bit of a pullback. It was literally just some people taking profit at the top, which was smart, and then pulled back, and some of those people repositioned for more longs. Meanwhile, there's a whole bunch of people who longed the very top at like 150x, 170x, 180x, 200x, and they got liquidated during a 15-minute pullback of 0.56%. I mean, think about how crazy that is. I think when I saw that 0.56%, when I actually looked at that number, I think it was about 11 minutes into that 15-minute candle. So I'm not sure if it even finished that 15-minute candle a little bit further down than that, but it was 0.56%. And they're already like, I think 10 or $100 million, whatever the number is. Not a huge amount for the overall day's worth of liquidations. In typical crypto fashion, there's usually hundreds of millions of dollars in liquidations, and coming from longs and shorts usually, right, obviously. And they're because of over-leveraged positions, right? There's really no reason on any given day for a person to be liquidated if they're not trading with leverage, because the asset doesn't move 100% in a day, right? Now, have there been days when Bitcoin has had insane moves like that? Yes, since like 2009. Were you trading in 2009 or 2010? Were you trading in on days when it had like 100%, bounce or drop? Probably not, right? Because if you were, anyway, right? But most people who are in the market, relatively new to the market, probably like you. I don't know who you are watching this, right? But most people who are relatively new to the market, you think you're hot shit. You think, oh, I can beat this market. Let's see. Now, let's see if you're smart enough to trade without leverage, right? First of all, trade positions without leverage and just stack them and rack them every day, little by little. Or are you the kind of degenerate that's just going to be playing like with dynamite And you can be like, ah, that bad shit's not going to happen to me. No, it's going to happen to you. It happens to everyone. Okay? Losses happen to everyone. Even if you're the greatest trader in the world, you're still going to have losses occasionally. The question is, when you have them, when you're using leverage, are you going to be smart enough to get out immediately? Or are you going to stick around thinking, no, I know better. It's going to go the other way. Right? Number one problem with traders. You don't get out when you should. Obviously, you don't take profits when you should. Obviously, that's really the number one problem. But aside from the fact that you don't take profits when you should, you don't limit your loss. And so here's the other thing. Let's say your target is, whatever, a second standard deviation move, okay, on a low time frame, because you're pretty confident it's going to go to a second standard deviation, and boom, it goes to second standard deviation, and you're in profit, whatever it is, 1%, okay, on the move, okay, and you take your profit. Wonderful. When it goes against you, and it quickly jumps to 1% in the loss against you, and it goes to 1.5%, are you going to rip that band-aid off? Remember, when it's running, right? Doesn't matter what direction. When there's activity, there's usually activity. When there's pressure on the buys or the sells, there's pressure on the buys or the sells. So the question is, will you know what to do? Because think about this. For every second a trade goes against you, you're likely going to need 5 to 10 seconds of the trade going in your favor to get back to where you were before it started going against you. For every minute that it goes against you, you're going to need 5 to 10 minutes probably before it goes back up. And you've just wasted those 5 to 10 minutes when you could have been in a trade and remade all the money that you lost in that 1 minute. For every hour, you're going to need 5 to 10 hours. At that point, you've missed your trading day, unless you're going to sit there 24 hours a day, in which case, for every day it goes against you, you're going to need 5 to 10 days to catch back up, most likely. And of course, if you get wrecked, you're going to need to insert more capital if you want to continue trading. And the whole point of trading is not to keep depositing capital to the exchange. It's to withdraw money from the exchange on a regular basis. Right? You should only be depositing money to the exchange at the beginning of your trading session. And it should be the money that you made, from the last time you were trading, or the money that you have from the last time you were trading. So let's say you start with an initial deposit of whatever, the typical amount's like $5,000, okay? That's like the normal amount people deposit their first time. And then they lose it within 90 days. And they just leave it there, by the way. They never take it off the exchange, which is dangerous because exchanges get hacked all the time. Right? So you need to self-custody, especially if you're trading crypto. You need to self-custody your funds offline into a hardware wallet in a way that keeps your money safe. Right? I mean, like on a device that's never connected to any, you don't leave it connected to any device. The only time you ever connect it to any kind of internet connection or whatever is to run a transaction. And then you immediately disconnect it. And you don't keep it in a place that's easy for bad actors to access, etc. The more of a pain in the butt it is for you to access your funds, the more of a pain in the butt it is for the actors, the bad actors, to access your funds. So keep that in mind. And if you think it's not possible that you'll ever be a target because you don't have enough money to be a target, believe me, even if you only have a couple $100, let alone a couple grand or a couple tens of grands or hundreds of grands, you're a target, right? The degens who are doing this hacking stuff, they are sniffing for data. They're injecting data onto your devices without you even realizing it. When you're clicking on a link, it can inject. Right, when you click on a link, you're visiting a page or you're looking at an object. It doesn't matter what the object is. You click on a link, something happens, right? You activate some code in the browser. Well, guess what? As soon as you do that, the hacker can insert code onto your system, right? The thing that you clicked on can be a thing that triggers code injections onto your machine. Once you have code injections on your machine, it can literally do simple things like log all of your keystrokes. So when you enter a password onto your wallet, onto your bank account, on this application or whatever, they literally have all that information. And then they just steal all your money. So think about that. I mean, just think about it. Why and how would you keep funds in an insecure way? Anyway, that's a talk for a different time. But yeah, Bitcoin is back over 100K, and what it really means, as you know, is because there's plenty of time for it to go up, down, or sideways to complete those mean reversions. At this point in time, depending on the time frame you're on, all right, you're trading in mean reversion right now, which is wonderful because that's what we look for. Because now we have a very known target to the upside on the mean reversions where there are targets to the upside, like where it's not likely to hit the third band again. We have targets to the downside where it could drop to, if it were to drop down to the RMLR in question. So that makes this point of time in trading technically easier, in the sense that if it runs up, you should be taking your profits before it hits that band because it's not likely to hit that band. And if it runs down, you know that you can take profit when it hits that RMLR, but you got to make sure that you don't miss the opportunity to take it maybe even before it hits it, because sometimes it'll move close to where the RMLR is but not quite hit it, and then the RMLR will continue on the next candle moving higher. Let's say you're dropping down to an RMLR. It came all the way down, almost hit it, didn't hit it, bounced a little, and you could have taken profit close, but you didn't. And then the next candle, the RMLR shoots up a lot. And that's actually where it's going to make the intersect, right? Or maybe it makes even several candles later where it's even much, much higher, right? And then all of a sudden, you'll notice that the completion was actually a sideways completion. And you should have taken profit when it was down very close to it, but didn't quite hit it, right? Now, if you see that it needs to complete the RMLR going to the downside, like in all probabilities, and the RMLR is continuing to drop the whole time, then yes, you can let it keep running, because it's probably going to go down and down and down until it hits it. But there are definitely times when you'll see breaks in those lines when it makes sense to take that profit before it actually hits that line. Just like you can take the profit on the move before it hits the RMLR's third band to the upside or the downside, right? Because you know that after it's already done that and it stopped doing that and it's in mean reversion, then it's not likely to hit those lines again. Even if it does, it's not likely. And even if it does, it's likely to just hit it and bounce right back through it or snap through it, right? So again, I hope this is making a little bit of sense to you. If it does, great. If not, if you actually want to learn the ins and outs, and I can show you exactly what I mean, I can show you how to use these tools, you can sign up for the Alpha Trading tutoring package, and myself or Bilbo will personally tutor you and teach you how to use our tools and our indicators and our methods of trading. We'll give you a bunch of wonderful little nuggets about how to trade that are not even shared in our documentation. Most of it is, but there's always some nuggets that we'll show you separately if you're getting the private tutoring, because yeah, why not? But yeah, that's a wonderful package. You get the indicators for an entire year, like all the indicators, and you get like 1,000 hours of tutoring, 12 sessions of 1 hour each, typically, of tutoring. And you have direct access to our DMs, so you can always ask us questions, and we'll always answer your questions that you send us by DM. And yeah, it's just a wonderful way to learn how to trade with the Alpha Trading tools. Anyway, that's going to do it for now, folks. Take care. Happy trading.